This time is different because the debt market has lost its footing and is now no longer a reserve asset of accumulation and that people want to hold. And in actual fact, gold is the beneficiary. I suppose that's the sunlight in what's a pretty doomer statement, is gold is here and it's big. Unfortunately, we're going to find out who owns the gold and who didn't. It's going to be a very polarizing event.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Memorial Day through June 2nd, 2025, while supplies last. First this week, we featured 2025 1/10-ounce gold eagles at just $59.99 over melt. Next, backdated 1-ounce silver eagles are just $4.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the Market Sniper. Francis, thank you so much for joining us today.
Delighted to be back.
Well, it's great to have you today. I did want to discuss something that you've been talking about, and actually since 2020, I believe you have been talking about a crisis in the debt market, but in particular, the Japanese debt market you've been reporting on lately. What is happening there?
Oh, wow. Yeah, long ends of debt across the world, in fact. So September 2020 was when American debt came into focus for us, and we called short and we traded the TLT then and again, and you lost around 45% in the next 2.5-3 years, which has subsequently seen a lot of big names also positioned to the short side, which some of them were mentioning in November of last year, like Stanley Druckenmiller and Paul Tudor Jones. However, America's collapse in debt has focused people's minds across all the nations. So after 2020, after that call, we actually took a look at British debt, we took a look at European debt, and we took a look at Japanese debt. And we came to the conclusion that we expected, actually, especially on the long side, long by duration. So that means 10, 20, and 30 years. I don't want to be too jargony. Many people don't understand bond markets. So long durations rather than 1 and 2 years, which would be considered short. And what's happening is those rates are going up. And the longer you are facing what is a financial repressionary environment, so that is, we need to devalue debt. So we're actually paying a much lower interest rate than is the true inflation rate. Particularly in stagflationary times, the inflation rates often get masked because there's downward pressures due to lack of growth and a lot of people feeling a recession at the one time. And then actually in terms of costs of living, there's quite strong upside. So there can be a sort of a dimming and a brightening aspect, countervailing forces. But in actual fact, it's stagflationary. And this is very much like Volcker during the 68 to 82 was a stagflationary period. Equity markets barely went anywhere. Things devalue. And we're going to have a bigger hyper version of that. In fact, we've begun to experience that. That's our overall opinion. And that's being led by devaluation of debt. So the rates going ever higher, a lot faster. In the Japanese, everyone assumed Japan's just barely over zero. And quite some time ago, we were doing YouTubes in 22, 23, talking about Japanese debt. They got the worst viewing numbers of everything. If you talk about Japanese debt market, it's absolute, lose everybody. I mean, 50% of our audience is American, by the way. Thank you to America for your support. A large part in the UK, Commonwealth. You'll put people to sleep. But it didn't help us because I was going to do it anyway, because I felt this was part and parcel of the great debt-based collapse. That means it's not just a US story, it's a global debt story. And this is why we've joked when we've come on board with you, we've spoken of lepers, the leper colony. We're all lepers. Not just American leper, there's lepers from all nations. We all kissed the same chief leper and did the same things and synchronized. There's no sound money nation, really, in truth, and there's debt all over the place. Now, the rates on many other nations are not quite as high yet as the US, European are lower, but they don't look after their military to the same degree. That's come up with the NATO discussions and Trump, and they're now having to spend more. So we've got upside setups across the board. Dutch, German, French, all the Northern European. Many people are a bit suspect and circumspect about the Southern European, but I'm showing you all the supposed legit nations in terms of financial prudence are all in upside technical structures for higher rates. And the UK is probably the closest to replicating America by being quite poorly set up and their rates going quite a lot higher. And I'll show you a couple of those charts. But what that means, Elijah, is that when rates go up, the debt needs to be devalued. It's going down. That's that hand. And when that's happening, it's good because you're shrinking your over borrowings, but it's bad because the rates are higher. And that means affordability of housing goes down. And housing is mathematics. It's, what is the average salary? How much can people put down? What's the likelihood on underwriting of them going bust? In other words, what's the environment like? A raising interest rate environment, borrowers are not very keen to borrow. They want fatter margins. They want bigger deposits. They decline more credit. They're going to be less flexible on subprime and damaged credit. And they are also going to price future increases. And the debt instrument they create, which is their asset, is no longer desirable for on-selling securitization to other investment companies that are in pension crises, because they've already stuffed to the gills with supposed debt instruments that have all lost immense amount of value. So debt is going out of fashion just as the most supply is ever coming into the stores. So that's why I always joke about pink Crocs. No one wants to buy them anymore, and you've got 6 oil tankers stuffed with them, bringing them to your store. It's the wrong product at the wrong time. That's deeply devalued. And in fact, you're going to pay to have people take them away, never mind an asset. And that's kind of where we are in the debt markets cycle. So governments are going to go into scavenge mode because they can't borrow as easily. So they need more tax. So you're going to get repressionary socialist agendas that are being driven, higher taxation, apart from the big, beautiful bill, which is more spending and actual tax breaks. But Europe, if you look at Starmer in the UK, is looking for bigger tax takes and is running out of money. He's chasing all his millionaires out. So Trump hasn't gone complete stupid, but all the cuts that were supposed to happen in doggy, that's all quietened down. Elon's cried off. And what's actually happening is the cuts all being pushed out, and it's all we spend now to make later. We'll always spend now to make later. So that's a can kick and very dangerous. And it shows we're not doing austerity, according to Donald Trump, whereas we're very big in the spend camp. And if it's Republicans, it's the military-industrial complex. And if it's the Democrats, it's quangos and welfare and inversion, perversion policies. So either way, both governments overspend.
I think a lot of people are disappointed to hear that, right? Thinking that with Doge and Trump coming into office, we were going to actually get the budget under control, but it looks like that's not happening. And once again, it's just kind of inflate or die, right? Is what it looks like we're headed towards.
I have to concur. That there's no realistic. As I've said, I brought up a diagram a number of times. I should maybe bring it up with you as well. But it's very difficult to turn things around at the moment. Once you're on this convexity slope, I'll just share it. It's very simple, basic diagram, but it essentially shows that when debt starts losing its credibility, it starts slowly. It's very much the bankruptcy curve in actual fact. First, that's slowly. So the credibility and valuation, it devalues slowly, but then the compounding starts to take effect, and then it becomes very, very quickly. And we're in this period here where decades happen in weeks. First, it takes absolute decades for weeks to occur, and then decades occur in weeks. You get the flippening. We're at the slippy slope, and if you weren't able to turn around when you were heading down and it was a marginal muddy decline, now that it's slaty, wet, and getting steeper, you're going all the way down. You don't stop the snowball that you created in the top of the mountain halfway down the mountain. It's hitting the village. We've passed that point. There's no point of return. And what he would have needed to have passed to be in any way have half a chance of even reversing this, I don't believe it could have happened anyway, but he would have had to have done incredible cuts, massive withdrawals out of Europe on the military, all forms of things, all forms of massive culls in statist employment, and reversed everything Biden hired all the way back, and all the boondoggles, which is the arms dealing corruption. I call that, the hyena's carcass feast, because everybody steals from the American taxpayer there. So, you would have had to have just really done that. He's gone and put $1 trillion out, bragging about doing $1 trillion for the military industrial complex, whilst telling everyone else they need to fight for themselves. So, I mean, it mixed messages in there. It's a spend, and it's just absolute acceleration of the controlled demolition. So any chance of not growing the debt has actually gone super fast. It's going to come at you hard and fast. And the key point I make about this, Elijah, is we had the TLT that we shorted. It fell by 50%, which is long-term debt, basically from 2012, the date we mentioned. What happened is the dollar was pretty firm during that period. More recently now, you've had the dollar be really weak. That's against pretty poor company, it has to be said. The real company you should be comparing it with is gold, and we know what's happened there. It's been a virtual parabola recently. But even against the Dixie, it's fallen from around 110 to sub 100. And that is a part and parcel of what many people are not understanding. When the debt devalues, it's then the turn, because they can't keep watching the debt devalue. They have to put a stop on it, confuse it, muddy up the water a little bit. The currency then has to take the whack for further devaluation. They still need the devaluation, but they can't. If it becomes a one-way bet to short the debt, you're just going to go into contagion and collapse. It's going to get disorderly. So they need a subtle way to devalue the debt for a while. They devalue the currency. But now everybody wants to do that because Trump's looking at a deficit, a trade deficit. He wants to make it more expensive for Americans to buy imported goods. A cheaper dollar has got to be the one to do that. But by doing that, he's reducing your living standards. And it's inherently inflationary as well. So he's going to push up the costs of everything that's imported. Now, some things you need are imported and you don't make them, or you don't make them as well. And it's not a sin, it's not a criticism to say that. You can't be masters of everything. And the problem with that is that's imported inflation. That's a reduction in living standard. It's going to reduce disposable incomes in an already bad recession, which has been a recession many times. It's qualified for a recession many times, despite what they tell you for new rules. So this is a doom loop of reducing tax take, increased debt expenditure, higher welfare as people become unemployed at a faster rate, a crashing housing market as the rates go up on the long end, a rejection of loans, banks not wanting to lend anymore because it's high risk and the assets they create are undesirable in an overly provided, over-proliferated debt space as a reserve asset. Nobody wants it. So that's a doom loop, and it's got to play out, and it's very bearish. But the king reserve asset is doing exactly what he should be doing, and that's gold. But the point of showing you this chart is that you're going to suddenly, Americans that are watching this, and friends, I'm sorry to say it, but your buying power of your dollar is going to lose rapidly. At first it's debt, then it's currency, then it's debt, then it's currency, and then it goes like this, and then they go together. And that's the capitulation phase. There's become less pauses in between, and you're getting the full deflation as everyone does it. That's when gold turns parabola, though. That's the good news about that. And just to draw that chart, gold will be the inverse of that chart. So it goes kind of like this. If I can draw it, let's just draw nicely with you in orange for the gold. It'll look something more like this. And then suddenly it parabolas like that. So for all those thinking, should I be selling my gold? It's amazing. We've barely done, I don't think we've done much at all. Should I be selling my gold is the worst question you should have. You should keep stacking gold right now. It is the reserve asset in a failing debt asset, and we're only just starting to see interest rates that could go a lot higher across the world, by the way. And I don't want the guys to think that I'm attacking the US. So let me just show you the British debt so that you can at least feel that debt is collapsing in many other nations. If we show you the 20-year, we're calling for 7.5% there and have done for a lengthy time. We've shown this 20-year instrument on a weekly time frame. When it broke, it was, when we called it, it was around 4.5. It's now at 5.36. So that's quite a move already, and we're looking for 7.57. That's going to be 7.6. You could find someone needing a fixed for 20 years for a mortgage purchase in the United Kingdom, staring at almost a 10% rate, with margin and defense and protection, and if he's not perfect credit and requiring big deposits. I mean, imagine that. The house pricing just has to re-rate because not enough people are cash owners in the property market, and all the lower demographic by age group has to have access to finance, and they need to borrow the most, not the older folk. And they are the people who will buy as people are passing on or downsizing, etc. So this is a very, very bad state of affairs. Japanese debt, we've called this one, wow, for a long, long time. You were down here at 0.2s, 0.3s. We had an amazing structure on this. Let me just get my draw tool back. That is since really, really ripped. This is super high. It's run up here. It keeps setting up. It keeps making new highs. You're at 3.2% on the 30-year. Let me show you German debt. This is the stalwart, the spine of Europe. You can see that it is at a lower rate than America for now, but in the long term, it's also going higher. Again, going higher. Beautiful technical setup here. You can see you were at almost negative rates a while back. You were at negative rates, and now you've got these structures with upside breaks to the upside now. Now, a little bit of a pullback right now. It's not the worst, but we have it going for 4%, the German rate. Let's show you the French. It doesn't matter who you run actually through this. There are upside structures for higher rates across the board. You can almost fit them. They're not that different, being as part and parcel of the EU. We expect up top there 4.5 going higher. These are moving higher. The Japanese, as you mentioned, the big concern with Japan, Elijah, is that the carry trade is based on that. A lot of speculative money that's gone into America borrowed in the Japanese bank, in yen, sold yen, bought dollars, and either put it in treasuries or Mag 7. If that has to reverse now because the cost of that funding is now getting too expensive, what ends up is you have sell the asset, which will be the stock market or the treasury, not a desirable outcome. That'll push rates up on treasury. It'll crash the stock market. Sell the dollar, repatriate back, buy the yen, buy the local treasury, if it was a Japanese lady that went searching for yield in America, or if it was an investment fund or hedge fund in America that borrowed there, or Switzerland for that matter. It's not only American institutions that have made use of the cheap Japanese financing. If that reverses, you can have all sorts of problems and you get contagion in the debt markets, because that will mean the most speculated in nation, which is America, expect mainly for the stock market and the unicorns. But if you get a withdrawal there, the worst thing that could happen is Mag 7 starts selling off and it's foreigners that are selling. Don't forget, the Swiss National Bank is almost a hedge fund of the tech unicorns. So that money reverses because people have concerns about the state of the dollar. That becomes a real problem.
You know, if we look at the banking system, I mean, one of the things that is coming to mind is that banks are often invested in U.S. treasuries. They're also, very exposed to real estate. So if we see rates continue to rise, institutions or countries dumping U.S. treasuries, and real estate falling because of rising interest rates, I mean, how is this going to impact the banking system?
I think the big thing that's not being spoken about is how wrecked the U.S. banking system is probably in the moment. Bank of America made a purchase of 500 billion treasury bills when the rates were about 1%. That collateral has lost a huge amount of money. You can get the same yield with 100 billion that they paid for 5 billion, probably approaching now. That's an immense capital loss. I think if we were marking to market debt instruments in banks, you would have to conclude that we're trading bankrupt. safely, I would imagine. And I don't think that's that different for many countries either. If there were mark-to-marketing process was entered into. And I think we're a short step away from a banking narrative because everyone's suddenly discovering the long bonds. Well, when they discover the long bonds, they've got to know that that's the tool for purchasing property. That's the asset that's created, a 30-year or a 20-year mortgage. And somebody is to be a buyer of that. Otherwise, the bank's got to sit on it on their own books. And what's the appetite to lend now when they're already holding too many lending-based assets of their own, and they've got a collateral of a house that could actually be housing, as I say, is mathematics. If the rates are twice what they were, the price should be half. Because people could only afford the same payment if they've not got an increase in earnings. And when you then look at the outlook for debt and the desirability of originating new loans, that's got to be worse than it has ever been because the debt markets have turned. That's why we said this is going to be the most significant call we ever made in September, because this is the technical call for reset. We all have said fundamentally this day would come, but no one could time it and say, when is it really? Everyone could just say, printer go brr. You can't do printer go brr because no one's buying the asset you're creating anymore. Just so that people are aware, the Fed is already intervening to buy. People are expecting rate cuts. The Fed is buying at the current interest rate. If you cut rates, you are upvaluing the bond. It's a bit like me saying, Elijah, buy my secondhand shoes for $100. And you go, no, thanks, Francis. And I say, how about $250, Elijah? Well, you're going to want it even less, I'd imagine. And that's what's essentially going to happen on bond markets if they even try to cut, which is why everyone's going, oh, the Fed's behind the curve again. Yes, they're usually behind the curve, but they can't move like you normally can. This time is different because the debt market has lost its footing and is now no longer a reserve asset of accumulation and that people want to hold. And in actual fact, gold is the beneficiary. I suppose that's the sunlight in what's a pretty doomer statement, is gold is here and it's big. Unfortunately, we're going to find out who owns the gold and who didn't. It's going to be a very polarizing event.
No, it seems like there's rumblings here and there about, checking if there's gold in Fort Knox. Trump has talked about this. What do you think will be revealed, if we do head into this reset? He who has the gold makes the rules, and even Trump tweeted that, right? So your perspective on that, like when it is really shown who has the gold out there?
I think the East really has the meaningful gold, particularly China. So the one thing I'll say to a uniquely American audience, I'd imagine, but much love as I have for all of you lovely people, the people that have managed your country have done you a disservice immensely. And I'm going to tell you it straight as it is. If you have a choice between being a producer nation that creates surpluses and stacks that surpluses in gold, yes, they are indebted, yes, they have a wrecked property market, and being a debtor nation that overspends consistently and undersells to others and borrows and creates debt instruments each time you overspend, in the event of a downturn and you stacking T-bills that people need to buy that they no longer want to buy and are devaluing, and the other person is stacking gold ounces, who is in the better position come reset? I think the rational amongst you that are not emotional will realize it's not a good position for America. And what I find is you get a lot of China is wrecked, China this. It's kind of like there's a problem, but let's point out how bad everybody else is. Just let's deal with the American issue. America's in huge trouble here, and it's not necessarily in the best position compared to other nations at all. And that's not me wanting to see a communist nation win over a supposed capitalist nation. It's a hard fact. It's a real downgrade in living standards for Americans coming in, on the basis of that, as I was saying, as the taps get closer to closer, it's devaluation of debt and currency. You're going to have the worst buying power in your fiat currency as a result of the loss of ability to borrow. And you're eventually going to have to live within your own means. And the issuance of debt is going to become less and less of an option because no one else will buy it apart from your own Fed. And they're already doing it to a degree. And the degree that they'll be able to continue beyond what's already a technical bankruptcy position is highly, highly limited. and everyone else will sell it until they own everything. And I don't think the people that own the Fed are that excited about that notion. So we're being prepared for the new financial system. So I don't think this gets to play out that we see debt valued at zero. We start to see real collapse. There'll probably be other geopolitical smokescreens going on and chaos, shock and awe, their financial equivalent. And then we're going to go, hey, guys, we need to do this. The banks got hacked. This happened. So we're going to get circuit breakered into some new system. And we've discussed this before, and it's becoming very close to a fait accompli right now.
A lot of people are talking about recession, right? And you said that based on different metrics, you could even say maybe we're in a recession right now. But do you see that when it becomes clear that we're in a recession on a mainstream view, that's when the reset hits? Your take on recession versus reset at the moment?
I think they need a lot of pain and suffrage, a big problem, to create a big reaction, to then drop their new solution. And I think a lot of people have seen this coming. So it's going to feel a little bit like the CV19 events, where there's going to be a lot of skepticism and a lot of anger. So I could see, again, I don't do this to be dramatic, please believe me. But I just think the scale of this issue requires a very scaled response, a big problem, a big reaction. So they might keep everyone's head under the water in this waterboarding exercise a little longer, so that you really come up gasping. We have to sign on the dotted line for almost anything. We have to be so on our knees. And I think that could affect a lot of things that are day-to-day needs. It can be power related, it can be access to food, etc., etc. They are going to push this problem. We're going to get a stark reaction, and then we'll accept whatever solution they give us. Because this is I don't think every lifetime gets to see this degree of economic travail. And I think we get a totalitarian nation and global order that comes out of this, which is quite concerning to me. Good news. Let's say something good news. Florida got gold passed as money. And a legal tender. So I love the fact that happened, and I'm upset that David Webb couldn't get it through in Utah, and that there was I think it's a senator, the head of that particular state. It's probably called a senator. I'm not sure. I don't understand American politics as well as you would, but he vetoed it. We really need to show up, because the bank lobby from out of state showed up to stop that from going through. We really need to see victories like Florida's victory, where gold and silver as legal tender, and no taxes for having it or purchasing it, those kind of laws. We need to see more of that. We can't be NPCs and sit here and just say, I bought my gold, I've done my bit. We've got to get the laws through. We've got to get people accepting sound money.
And on the topic of gold and silver, I mean, you mentioned how gold will probably end up going parabolic in this reset situation. I did want to ask you about silver and also other precious metals, platinum, palladium. We have seen a big move in platinum recently, which really platinum hasn't played at all along with gold and silver in this recent move over the last year and a half. So your take on those other monetary metals, do you anticipate there will be gains in those along with gold and silver this time?
Yes, I did a chart finally on that I think I shared on Twitter, so I'll show it again. So platinum has been probably, I would argue, probably the most undervalued of the precious metals. When I show this chart, it might help me make that case, because some will think silver is, and I won't say silver isn't grossly undervalued, but I would still make the case that maybe platinum is the biggest. Platinum's last high was here in 2008. So let me get my big pink Koki. This is 20 years of metals, by the way. Let's just highlight this, 20 years of metals. And I've got a couple of metals on here. So the blue is silver. That's XAG is the blue. The gold is orange. So the orange is gold. That's XAU. And then the gray is palladium. This one that had a huge run up to there. And then the actual candles chart is platinum. And then I just put in for fun rhodium. It's very, very small. I don't think you can meaningfully buy it. There's a ETF you can track. It's along with palladium had this huge run into 21. So that's rhodium. And you can see palladium also a huge run. They were eating platinum's dinner, particularly palladium, not so much rhodium. It's a unique metal, rhodium, a very small number. But you can see platinum was actually barely moving and actually drifting off. And it started over here. You could see palladium was separating itself from platinum already. So the palladium begins to overperform. This is part of the end of the diesel engine wanting, to kill the diesel engine, particularly green agenda. This was extreme palladium overperformance to platinum. So platinum was really left behind. It had a bit of substitution taking place as well, going on. All the money was going into that. And then that was the peak for the palladium platinum 2020-21, just into the early part of 2021. So there's a couple of things happening there. And then I will show you gold in this chart began its run more strongly from around here once it broke out. So gold is the reserve asset since the debt failure. The debt failure that we called end of 2020 really only started end of 22. People started to go, damn, this isn't right. What's going on in the debt markets? So the gold started to get the substitution for T-bills really here. Silver partially participated, but not to the same rate. So there's been a broadening and an expansion, and we are sitting very low vol on the 100 gold-silver ratio, a separate point, by the way. There's a breakout in one of the directions. I don't know. I'll wait and see coming, potentially. Rhodium and platinum corrected really hard. My apologies. Rhodium and palladium corrected really hard after this pink line. So they lost 60%, and rhodium actually lost 80%. From that April high. So they had real rough corrections. Now, platinum, if we look at it just on its own, because it's very difficult to see in that, and I just bring up a platinum chart, this is a massive falling wedge of devaluation period that's then broken out of. So we eventually broke out of that, and then we're in a nice squeeze for the first upside in a new trend. And the Chinese we're hearing are buying. And I bring you back to the gold-silver ratio. It seems when gold goes up to 107, maybe the Chinese are buying more platinum. They're looking at the relative silver. Silver. When we're at 107, and then when we fall below 100, the gold bid comes back in. So you might be finding that now platinum is being included in that, having not have moved. It's incredibly rare metal, and it is. Russia and South Africa are basically 70% of the market plus in terms of mining. They're hardly the bastions of stability, and they're both on the brick side of the fence. So you're getting interesting points. Zelensky came into South Africa. Few Americans will be aware of this. Met Cyril Ramaphosa, who was the gentleman you saw the recent Trump theater with, and bought North Platts, which is a big platinum provider, 51% controlling stake. Now, Zelensky's got a lot of interesting billionaires who are behind him that got him the role that he has. And you can make of whatever you want with the Ukraine war and all that goes on. But it's fascinating to see them choosing to invest in this way and buying South African platinum producers. So I'm quite almost shocked and a bit disappointed that that's been allowed to happen. But I throw that in as an interesting anecdote for you. So I would expect that it's a well-timed investment, could well turn out to be the case. And in actual fact, it is currently barely much higher than its price of 20 years ago, while most of the others are still significantly higher. So I do think it has a real run. By the way, Americans, you don't pay VAT or typically sales taxes on it, so you can essentially buy it for roughly spot plus a spread, a dealer spread. So it might be an interesting one to have. Just bear in mind, if you're a seller, it's a bit unique, and they don't typically come coins, so you'll probably be buying bars, and you may find capital gains taxes are being applied on later on bars, while numismatic might get a little bit more slack. So there's some things to bear in mind, but the overall catch-up could actually see platinum do a bit of a palladium, what palladium did when it was really in season. you could have an absolute blowout run. That was huge from palladium. Rhodium is such a thin market, it's very difficult to even treat it as a use case example, but that's what happens in thinly provided, highly sought after metals. And I think platinum is way down here in terms of where everything else is, with gold over there. I spend most of my years with platinum being a much higher gold price, higher than the gold price as a asset in dollars, and it's rarer. So who knows? It's just not as monetary. So it's a little bit of wild card in it.
And if our viewers are interested in learning more, Francis, they can go to themarketsniper.com. We'll put a link in the description of this video, as well as your YouTube channel. Can you tell us a bit about that?
Yeah, sure. Our primary goal is to wake up as many people to the fact of where the financial situation is. Traditional financial advice is not going to serve you that well in untraditional times. In fact, the traditional financial advice was a 60-40 portfolio. We don't think you should be owning any form of debt instruments, and we think you should be oversized gold. That's just one example of how we position. Well, our goal is to help you build more wealth, protect that wealth. Americans need options outside of America potentially for optionality. So not only build it, but protect it and secure as many freedoms as you can. So those are our three goals. Our YouTube channel, The Market Sniper, also on X, and the Crypto Sniper, it is going to play a role. I don't like it, but some of those things are going to be inflated immensely to take over the traditional role in the traditional world. So we will be partially engaged there, although our primary holding is going to be in the physical markets of metals particularly.
Fantastic. Well, Francis, really appreciate your time today. Any last thoughts before we let you go?
Yes. Keep the sunny side up. It's a great life. Be prepared. It's an obstacle course. We're all going to run it together. You were born for these times because you can do it. Just start taking any form of action. It'll lift your mood. Don't get bummed out by it. Don't trust the political system. This is a controlled demolition and it will occur. It's a certainty as far as I'm concerned, and that requires preparation. Like any crisis, you see it coming and you make preparations. If there's a typhoon or a hurricane, you're used to it as a nation that faces strong natural weather. You just have to do the financial equivalent now for these times, and you can come out better. And also look at optionality and having rural and out-of-state options to help support you during these times.
Fantastic, Francis. Thank you so much for your time, and God bless.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin weekly specials for Memorial Day through June 2nd, 2025, while supplies last. First this week, we featured 2025 1/10-ounce gold eagles at just $59.99 over melt. Next, backdated 1-ounce silver eagles are just $4.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.